Hi, and welcome to Macro Wednesday, where we talk macro, trying to make sense of markets that they don't really make any sense, but more importantly, answer your questions so we can become better investors. I'm your host, Steve Van Meter, and thanks for joining me today because we're going to try to answer the question on everyone's mind, because you sent me a bunch of emails asking me this: is the dollar dead? The answer is no. I still remain dollar bullish, even though the dollar has been massively bearish lately. But no, I don't take a position in currencies. They're too risky for me, but I still have a very, very strong opinion on the dollar, and we'll get to that right after we take a look at the economic data. And let's switch over here to investing.com. And if you're new to the show and you want to know where you get this, go to the news tab, and under there is the economic calendar. You can also download the app for your phone. It is free. And let's go back to Monday, where we have the producer price index, and this is prices coming out of the factory in South Korea, improved from minus 1.8 to minus 0.9. There is a recovery here, certainly not a V-shaped recovery by any stretch of the imagination. Is a recovery, but definitely deflation still coming out of the factories in South Korea. Let's move on into Tuesday and see what interesting things we had, which was not much. Into Redbook, skip right over one of my favorite data points. Redbook same-store weekly retail sales. Remember, this is brick and mortar, not online sales, and it got worse from minus 5.5% on a year-over-year basis to minus 7.5%, and on a month-over-month, it slowed from 3 to 1.9. Let's click on the year-over-year and dig in and just see how bad this looks, and it is terrible. Because when you go back to the great financial crisis, you can see it got down to a low of minus 5.42. I mean, barely got back to that level right now. So same store brick and mortar sales, big trouble, not showing any sort of rebound in the economy, unlike what the stock market is predicting. How about we move into Tuesday evening? Japan just cannot get a break here. Their manufacturing PMI on a preliminary basis shows further contraction, and their services PMI on a preliminary basis also shows further contraction. Not big ones, but, well, the manufacturing's not. We'll just say contraction. We'll say services in the slight contraction range. Not good for Japan. Moving into today, mortgage applications continue to tick higher at 4.1% over last week, mostly being driven by refinances. Purchases are up, but it's starting to appear that people are fleeing the big cities. There is just a huge demand for homes. Baffles me, but nevertheless, and there's a lot of refinances. Now, keep in mind, for those who think the housing market continues to run on new purchases, remember, people that refi tend not to go out and buy a new home shortly thereafter. Refis aren't free, and you're usually stuck in there for a while. I mean, you could get out, but the whole point is if you're refining, your intent is not to move. Looking at Canada, our neighbor up north, consumer price index on a year-over-year basis rebounded from minus 0.4 to plus 0.7 in June. Again, following kind of pretty much all the CPIs around the world showing a modest rebound in consumer prices around the globe. Obviously, Canada's was a pretty decent jump there. Moving into the rest of the U.S. data, housing prices up 4.9% on a year-over-year basis in May. No surprise, housing prices and housing demand continues to move higher. In fact, I talked to my realtor, or not to my neighbor who is a realtor, and he says, yeah, Steve, if you want to sell your house, we would just ask, and I don't. So just in case my wife who's listening wondered if I had a change of heart today about that, I did not, or my father, who is probably listening too. Nope, we're still here for a while. I just was curious, and he says he's recommended that his clients put in and ask $10,000 over the offer, because he says that's what it's going to take to even get someone's attention. So it's just crazy demand. I asked him why. He said, I don't know. He says it doesn't make any sense to me. And well, that maybe he should have his own show about real estate markets that don't make any sense. I'll have to mention that to him. Anyways, existing home sales on a month-over-month basis in June rebounded. That was expected after a couple months of declines. Moving into crude oil, here's something that baffles me. The market was looking for a draw. They got a build, and oil prices yet rallied today, as if people think that this crude oil inventory build is not a big deal. It is. Looking at Cushing, it rose as well. Gasoline inventories down a little more than expected at 1.8 million, and distillate stocks up 1 million. So let's look at this crude oil report that was up almost 4.9 million barrels. And if we look into this, and again, I'm not the foremost expert in crude. I just try like looking at what's going on in the market. And normally this is the time of the year you expect to see draws. So here we are in July, and we should be seeing more draws than builds. And we go back to the last time in 2019 in July, and what do we see? Draws, 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 draws. And we keep going back out. And let's see, right in here, we're in July. Again, there were some builds, but there were far more drawdowns. And we keep moving back to July in 2017. Generally, this is a time of the year you see draws. And back even in 2016, you're going to want to see draws around this time of the year. So the market seems to act as if this is okay. I tend to think it's an issue, especially when you look at oil price stocks. You know, we're headed into the fall here. School's going to start back up. We do know, at least in California and probably other states, you know, buses aren't going to be rolling. And usually traffic picks up. Now, not that that is a big driver of oil demand. Nevertheless, if there's more people staying at home, how are you going to get any demand? So I can't remain, I'm not bullish on oil. I shouldn't say I can't remain, because I'm not bullish to begin with. But nevertheless, the market seemed to like that. I don't get it, but nevertheless, that was the take today. 20-year bond auction from out of the U.S. was met with very strong demand, and yet yields fell afterwards. We'll take a look at that when we get into the charts. The other thing I want to look at is the Chicago Fed National Activity Index, which shot even higher. It was kind of unprecedented at 4.11. And even the Chicago Fed says, look, you can't look at the month-to-month numbers. They can be very, very volatile and not quite the accurate number you're looking for. And so they said they do say you should always look at the 3-month moving average, which rose from minus 6.36 to minus 3.49. Now, if you don't know how good or bad that is, well, it's handy they actually tell us that over here, the moving average below minus 1, let's see, economic contraction have historically been associated with the values of the 3-month moving average below minus 0.7. So at minus 3.49, it still suggests that, well, things aren't quite that good in the national economy. All right, so let's talk about the dollar. As I mentioned, I have some very strong opinions on this. Let's kind of get out of the way a couple of reasonable views on the dollar. One is from Jeff Snyder of Alhambra Partners, really smart dude, and he says that, hey, the dollar weakened because the economy was reopening. Totally valid point, and I would agree with that. Another view, which we actually see in the bond market, we've talked about on this show a little bit, is the European market economy opened before the U.S. Because if we look at how the virus progressed, right, it was Asia, Europe, U.S. So it would make logical sense that things got better in Europe first, and as the economy opened, there's a big demand for euros. And this kind of may not make a tremendous amount of sense, but when we look at the charts in the bond market, what did we see in the overnight? Remember I said there's this midnight seller? Well, it was generally in the European market. So there's some belief that, you know, whether it's European central banks or European banks or somebody over there was buying up a lot of U.S. Treasury debt because they were concerned about a weakening economy. As the European economy started to reopen, there was a demand for euros, so they sold their treasuries, right? This makes sense. What did they get when they sell treasuries? Now, you don't get euros, you get dollars. So what is the first thing that happens when you see the selling of U.S. treasuries in the overnight market? Well, we would expect to see yields fall. And yes, I did fix the wide screen. I somehow figured that out. So we're still wide, but not as, you know, zoomed into my face that I'm sure you'd rather not have in your face. So we see yields fell in overnight trade during European markets. Makes perfect sense. But we also saw a bearish dollar. Now, why is that? Because when you sell U.S. treasuries, you get dollars. But what did they need? Euros. So they sold treasuries and then dollars to get euros. So what would you expect? You see yields rise, dollar fall, euro rise. Did we see that? Yes, we did. So that is another explanation. But let's kind of maybe approach the dollar from a different direction. Why do things lose value? I mean, in general. Well, you can produce too many of things, of something, right? I mean, we see that in the auto industry all the time. Sometimes a manufacturer has a car they think is going to be a big seller. They build a bunch of them and no one wants it. Or sometimes they have a really good seller, and so they decide to just flood the market with it, and then all of a sudden demand goes away. So you could see that too much supply, and you could see that maybe there's no interest in, maybe there's just no demand for dollars. That could be a reason, but what are we hearing in the mainstream? It's too much government debt. Oh, it's the government's borrowing all this money and driving the value of the dollar down. And it baffles me that people make claims and they don't even make a chart about it. Well, on this show, we have charts. As you can see by the tabs, we have lots of charts. And I know that makes Chris Dark, big friend of the show, very happy. So we've got charts and more charts. So here's the first one, trade-weighted dollar against federal debt. Well, it appears to me that since this trade-weighted chart came out in 2006, that the dollar tends to rise as the debt goes up. Now, well, why is that? See, the great thing about macro is it makes you think. I mean, you can look at the chart and you can see the relationship there. But why? Well, think about it this way. As government debt gets bigger and bigger and bigger, if the private economy isn't growing enough with it, the federal government crowds out the private market. And when it crowds out the private market, who is loaded up in debt, because we're in a debt-based economy, what does it make it harder for consumers to do? Get dollars. And why do they need them? To pay on all their massive amounts of debt that we have. And if there's fewer dollars because the government's crowding itself in and borrowing everything it needs because it's getting bigger and bigger and bigger and growing faster than the private economy, the dollar should go which direction? Yeah, it should go up. I mean, okay, so that chart makes sense. So the view that the government's borrowing a lot of money, that weakens the dollar, I'll just say no. So what's the next argument? Oh, well, it's the money supply. Of course, the money supply is going up. Well, that's got to weaken the dollar. Well, that doesn't really look accurate either, because we can see right here the money supply went up and, well, the dollar went up. If that was true, then these two should be fairly inverse, and there's no evidence that, in fact, here we see the rising dollar and a rising money supply, and then they fell together there. So again, that doesn't make any sense to me either. So I have to think about, why is the dollar falling? Is there too many of them? No, that's not the issue, because we do know that the Fed has contracted world dollar liquidity. I'm not going to put that chart up, but because there's no update. But we know that for a fact. There is a shortage of dollars in the foreign market. So why is the dollar weakening? Well, I'll give you a really good reason why. Because consumers don't need dollars. What do you mean they don't need dollars? What did the U.S. government do recently to make people not worry so much about their finances? And that's going away next week. Actually, I think this is kind of the last week of it. The $600 bonus, right? The unemployment credit. Many people, over 50%, I think the data says, over 50% of the people that filed unemployment claims got more income not working than they did working. So do they need dollars? No. Now, how many of those people probably really needed dollars? Can you imagine maybe somebody who was making 30 grand a year? Do you think that they were hustling to make that money because they had a lot of debt? Yeah, probably. And now that they're making more money, there's some relief. They actually can put dollars in the bank, and they can actually make their debt payments. In fact, because of all these loans on forbearance, some people can just pile up the money. So there isn't a demand for something because they don't need it right now. And I said, well, wait a minute. Is there something to that? Yeah. So let's take a look. The savings deposits in the M2. So now maybe the M2 doesn't matter, but maybe there's something in the M2 that matters, and we could see savings deposits have been rising. If we click on this chart, we can see, wow, look at savings deposits, and boom, they shot up, right? And we know that was likely to happen because people didn't need the money. The government it didn't make people whole. It made them more than whole. And so some people spent it, some people put it in the stock market, and some people saved it. So there's not a demand for dollars from them. But what's about to change? Well, that $600 is going away. And the latest rumors from the rumor mill out of Capitol Hill is there's going to be a $400 per month instead of $600, again, per month, not the week, not $400 a week, $400 a month, or $100 a month unemployment bonus going forward. This is the latest rumor I saw just before we went live. So what's going to happen with the dollar as people's income goes below where it was when they were working? Well, they're going to need dollars, and they're going to pull them out of the bank. And at some point, all these loans on forbearance are going to start coming back because, the banks are going to have indefinite loan forbearance. So we know there's 100 million loans that are in forbearance. The earliest ones that would have started was March. So we have March, April, May, June, July, August. Well, that's coming up pretty soon. So we know some people are going to have to start making payments on something next month and in the months to follow. Whether it's going to be a lump sum of the last 6 months or it's going to be tacked on the end, it's immaterial. They're still going to have to start making payments. The money is going to have to start coming out of their bank accounts. So let's see, how do these charts relate to the dollar? Well, I overlaid total savings deposits in red with the trade-weighted dollar. Hey, what do you know? As savings rises, the dollar rises. Well, that's interesting. But look at the end here. The savings shot straight up. Dollar went down. Maybe if we switch it to a year-over-year basis, that will help. And, pretty much what it told us is what we already know from the money supply data, that we can't infer a lot there, but there is some indication that perhaps people aren't really needing dollars. Their accounts now have enough money in them that there isn't a demand for dollars and they're weakening. So is my whole view on the dollar have to do with money coming out of bank accounts? Not specifically, but that is interesting to think about. And will there be a demand for dollars in the future? Because I've said, and I'll stay on record, that the tax cut was a mistake, and I'm going to say that this recent government transfer was a mistake. And I'm not suggesting that we shouldn't have had a government transfer. I'm suggesting that it was way too much. If you want to make people whole, fine, make them whole. But giving people too much is a problem, and I'm going to tell you why. Because this would all have been fine if the economy is going to rebound, and that was the bottom we saw a couple months ago. But what does it appear is the reality going forward with somewhere around 30 million people on some form of unemployment benefit, whether it's state or the PUA, doesn't matter. What is the issue? We're not just going to face a double dip recession, because double dip is not like your Thrifty's ice cream cone that my wife and I got when we were kids, not together because we didn't obviously know each other. It is not a double dip ice cream cone, and even more delicious. It's worse. It means we're headed toward a depression if this thing rolls over. And the reason I said these things were a mistake was very simple. What do you do when things are really bad? You cut taxes and you help give people money. Guess what we're not going to be able to do this time? If we see a rollover in the economy, we're not going to be able to bail things out. We've done it. Because what we're seeing right now with the government debt, it is so intrusive into the economy that not even Congress can even decide on giving people more money, because they know they went too far. And they're going to probably go too far again, even if it's a small amount, and leave them in a bad shape to rescue the economy. So think about this from a dollar perspective. When all this debt does come back where it has to get paid, and 30 million people are out of work, they drain their bank accounts, now they're forced to sell their stocks. Now, why do I keep saying that deflation has a negative impact on, say, gold and equities? Because people are going to have to sell stuff. If you took your $1,200 one-time bonus, which maybe there'll be another one, and maybe you bought some Tesla stock and you made a bunch of money and you're really excited about how much you're up, And all of a sudden, one day in the not too distant future, you're sitting with your spouse at the table. You got a bunch of bills that are rolling in. You're not back at work, and the kids are looking kind of hungry. And what's the decision? Well, we better sell this stock. Or maybe we should sell the gold, those gold coins we bought, or that paper gold in our brokerage account. People are forced to sell because our monetary system prioritizes one thing: debt. You don't pay your debt, the government or courts take it away. So if you're out of work, do you want to be homeless? No. Do you want to lose your car? No, because you look, I know we're in a virtual world these days, but maybe you're going to have to drive to go get an interview, and you can't take a ride share anymore because of the virus thing. Look, people don't want to lose their homes, their cars, their boats, their toys, and all that other stuff. A debt-based economy prioritizes debt payments, and hence in a period where the economy tanks, people become net sellers. And why do they become net sellers? Because there's a demand for dollars, and there aren't that many of them. I told you I had a strong opinion on this. Let's look at some more charts. Here's a great one if you want to recreate this one. Trade-weighted dollar against average hourly earnings adjusted for inflation. Look at that. We saw that big government transfer of money, and the dollar went up. And now look. That transfer is starting to roll over and head lower, and the dollar is headed down. Does that mean that perhaps we're going to see inflation-adjusted wages continue to fall? Well, maybe we'll see inflation-adjusted wages can rise. Under what condition? Which way does CPI have to go? Oh, yeah. If you're bearish CPI, and this guy is, could have bullish implications for the dollar, just like, we had back in 2008. Look at that. Let's check this again, except now we'll do it against real yields, because if you've watched this show for very long, and I do have a question that came in that I will get to at some point about real yields. I think I'm very bullish real yields. I think real yields rise. Even though treasury yields are falling, I think consumer price index is going to fall even more. And so here you see trade-weighted dollar in blue, real yields in red, and real yields, look, they went up. The dollar went up. They're rolling over. The dollar's going down. If real yields rise, then bingo, you've got a rising dollar. Now, how about my last chart, which I totally forgot what it was, and now that I'm looking at it, oh yeah, this is the chart. If you want to say, why is Steve bullish on the dollar even though it's going down? Oh, maybe it's because he's dumb. It could be one. Maybe it's because he doesn't know what he's talking about. That could be it too. No, it's because I think there's going to be another massive round of QE that's going to make the last round look rather small. And I think we're headed into a double dip. Well, I think we're headed into a depression. I think the economy is going to roll over because the government can't stimulate people through it. The situation is that bad. And so if the Fed does a bunch of QE, let's go look at what happened with the dollar. So here we have back at QE1, the Fed blew that, and look at that. Boom, dollar shot straight up. Now, it didn't have the direct impact QE2 did. Oh, wait, here's QE2. There was a delayed reaction in the dollar, and QE3 caused a delayed reaction in the dollar to rise too. And look what happened right here. And I'll zoom in a bit so you can see it. But look, QE whatever version, I guess it's 4-ish or maybe more, I don't know. QE up, dollar up. See, I'm bullish on the dollar, not because it's gone down. And look at that, the amount of the Fed's balance sheet, because again, this is the total balances maintained, right? This is not just the monetary base. This is a QE part of the monetary base. So look what happened. The total balances have maintained have rolled off. Now, why have they rolled off? Is the Fed tightening? No, it's because those currency swap lines and the bank loans, what are they called? Repo operations have rolled off. Is the Fed stopped doing QE? No, they're still doing it. And on Monday, we're going to find out at 11 a.m. Pacific what the next week or two of QE is going to look like. Because remember, Powell said, I am not going to drop QE below 120 billion a month. So until the next Fed meeting, we have to assume that's going to continue. So if we get more QE, which is bullish for the total balance is maintained in the Fed, which would then imply that this drop in the dollar is temporary because we're going to see more QE causing the balances to rise. And if we get another big QE because the economy rolls over, which it looks like it will, then you get a massive shoot higher in the dollar. And that's how I can be bullish on the dollar over a longer term from a macro perspective, even though in the short term it's down. Pretty cool, right? And if you think about it, the Fed's buying bonds. So there's a question that, well, how does this mix in with the bond market? Well, if the Fed's buying bonds, that is suppressing yields, so that can bring yields down. It's the reason the dollar rolled over is because the balances at the Fed dropped due to, again, the repo loans going to effectively zero and the currency swap lines getting repaid. It doesn't mean the dollar shortage is over, nor does it mean the dollar is headed down. Pretty cool, right? Okay, let's get into some charts that I'm totally not overly prepared to look at, but let's take a look at some anyways. Oh yeah, I was looking at why crude went up despite the inventory build today. I thought that was interesting. Crude's fine to get back above its rising trend line. And since we're on crude, let's start with crude. Let's get over the dollar. And, you know, again, if we see a big bullish move in the dollar, this is how I can be bearish on crude oil, bearish on oil stocks, bearish on financial stocks, bearish on equities, bearish on currencies, or not currencies, I meant metals like gold and silver. Because this is what happened in the great financial crisis. We got that big blow of QE. We got a big spike in the dollar. Now, does it mean that long term I'm still bullish on, say, metals? Yeah, I am. Short term, I think we see a big drop, and that drop gives you the confirmation that we are actually in a legitimate bull market for metals. So anyways, let's look at the dollar. Again, everyone thinks the dollar is dead. As somebody posted on Twitter and tagged me in, which of course I can't post, they're seeing a potential double bottom. Yeah, absolutely. There's a potential double bottom in the dollar. And if you look at this rising trend line, again, I do not draw perfect trend lines. I draw general trend lines, as you probably know. Going back to 2011, the dollar is in a rising trend line. But guess what? The government debt isn't going down. So the notion that the dollar falls off the cliff doesn't make any sense here at all. Now, could it go down to the 94 range and reconfirm this rising trend line? Sure, it can absolutely do that. The other side is it could be a double bottom right here back at its March lows. But remember, the March lows, once they kicked in, they moved quick once the Fed had to do more QE. But what triggered the March low? Well, there was a illiquidity event, and of course you also have the yields absolutely drop too. Let's take the S&P. Look at the S&P 500, still find that rising trend line, define all logic of looking at fundamentals. But hey, as long as order flow comes in and it's being run through high frequency traders and the order flow is bullish, well, you can get rising stock prices at least until money dries up. Well, when's the money starting to dry up? Next week. And then the PPP loans start to expire in early August, where money is running out there. At some point, people are going to need to sell when those debt payments return. They're going to have to. It's always been that way. The government cannot get us through this. How about the Russell 2000? It fought back over its trend line. The VIX, which we do have a question on in today's Q&A, so we'll answer more about the VIX later. But it's sitting under its 200-day moving average. Vol sellers want to see vol go down. People that are bond bullish want to see volatility go up. So you can guess what direction I'm thinking vol goes. How about 5-year Treasury yields? They finally broke down below their trend line here, suggesting that yields are going to start rolling over and making their way down to zero or negative on the 5-year. 10-year Treasuries also, I think, are headed negative. They need to get kind of below this line at 0.56%, and they're slowly moving down. How about the 30-year bond? It needs to break below this line here that's roughly around 1.25%, and they're rolling over. So any sign of inflation not here in the treasury market. Let's go look at TLT, because it gives us a much better picture of what's going on in the bond market. So we've been talking about this descending trend line, which is actually a triangle pattern without the remainder of the triangle drawn in, and how the second highest point here is where the strongest level of sellers has been at. And that once TLT gets through this, which would be the inverse of the 30-year treasury yields, then you're really looking at breaking through roughly 1.2%, which is approximately where the solid purple line is, and then off to the races as bonds break out into their next, or they're probably their final stage of their bull market. And who knows what's going to happen after that, but there's going to be a massive move higher. And then we moved into this triangle pattern, or this consolidation pattern right here. And consolidation patterns are simply where buyers and sellers are exchanging blows, right? Sellers are at one point, buyers another, and we're consolidating. A seller's trying to get rid of the inventory, a buyer's trying to get more inventory. So when you see a consolidation pattern in the charts, it generally is a continuation of the overall trend. Well, what is the trend of TLT? It is bullish. What is the trend of yield? Bearish. So that would imply that this should continue the rising trend. And sure enough, it is. So it broke out of this consolidation pattern. The overnight sellers in the Asian market, non-existent. Overnight sellers in the European market were buyers, and it got right up to this dotted purple line. Now, why does this dotted or this dashed purple line matter? And let's zoom in, because right now the bond market matters a lot. The bond market breaks out into the bull market, it's just going to cause massive havoc, unwind of stock prices, and should cause the dollar to shoot higher. Well, here's that peak right here, that second high peak on the downtrend line. It matches right here, and look what happened. It came up and tagged this as resistance, because remember, it's acting like a ceiling. So it came up, tagged resistance, failed, broke resistance, and look, sellers came in. What does this tell us? The sellers are still have bonds to sell. So they dumped them down, buyers kind of came in, sellers dump. Buyers came in, couldn't handle it quite into the close, and then some buyers right at the end stepped in. Positive day as the bond prices were higher, but all this is telling us is once these sellers are exhausted, and you can see they're pretty aggressive, right? Red candle, red candle, red candle, red candle, red candle, red candle. I mean, every day they're pretty much coming in and selling. Once their inventory is exhausted, well, who are they fighting against? The Fed. And tomorrow, the Fed has a 30-year auction, QE auction. On Friday, they have a larger than normal Treasury note auction. And on Monday, where we get the new schedule, they have a 30-year bond auction. The Fed is going to eventually absorb all of the selling. And you can see the sellers are just running out of ammunition because they need to get bond prices way down, and they're just not able to do that. So very positive action. Once these sellers are blown out, bond prices go straight up as they normally do in this event, and that should be a big unwind in the equity market. All right, let's get to your questions. I've got 2 of them, or 3 of them, I'm not sure. Mr. Bond, it appears I have a question. On Monday night show, you mentioned the volatility index. I did. Could you please explain your theory behind it and how it relates to the markets, either supporting the existing trend or when it signals a possible turning point? All right, let's start with that piece. Let's go back to the volatility chart. Let's overlay that, and this should help you a bunch. Let's overlay the S&P 500. So when volatility spikes, equity prices sell off. And when volatility falls, usually equity prices rise. So how do you interpret this? When volatility is rising, what it's telling you is there is a large disconnect between a point of when someone sells and then the next person buys, or when a person buys and the next person, where the next offer is to sell at. It means there's a large disconnect. Now, why would you expect, what periods would you expect there to be a large disconnect? In a bull trend or a bear trend? Well, it's in a bear trend, right? I mean, imagine you're in a movie theater and it catches on fire and there's only one door out of the, there's only one door in and one door out of the seating area. There's going to be a mass stampede to get out that one area. And then what's going to happen? All the theaters are going to come together and have to get out the main doors. People will do anything to get out. And that means they will sell at any price. They don't care. They want out. And that's when volatility spikes, when there's just a massive amount of selling and people will, they just take any price. In a bull market, what happens is volatility gets compressed where there's a very small change in price. So that's how you can look at that. Now let's get back to your question and see if I indirectly answer that. So how does it, okay, so I think we related it to the market, and falling volatility supports the existing trend of the bull market. Look, I don't know how to time the VIX. I don't think many people are very good at it. Please explain your thought process on the significance of volatility at the turning points. Well, it's simple. When volatility starts to rise, you definitely have the risk of a turning point. The risk you have with volatility is when it gets out of control and it causes people to sell their equity prices to hedge their volatility shorts. So what happens is, to boost equity prices even higher, people will sell volatility. And there's a ton of vol selling strategies in the market that came out since the great financial crisis. So they will sell volatility. Well, the problem is, once volatility starts to get out of control, if you're short volatility, meaning you shorted it where you don't have it, well, either you don't own it or you shorted it and you need it. In either case, you need volatility. Now you become a buyer of volatility. And if the markets don't have a lot of liquidity in them to absorb the selling of equities, now you're a forced seller at any price to hedge your investment portfolio. All right, so let's see what else we've got. Many other prominent market analysts speak of it, and I assume their listeners know what the relationship means. Well, now, hopefully you do too. Goodbye, Mr. Bond. It was a pleasure listening to you, but I'm afraid your time is very short. Ah, yes. Who knows? Mr. Bond may become Mr. Equity, Mr. Commodity. Who knows? Probably not going to be called Mr. Volatility. I'll tell you that much right now. No more volatility. Loving your YouTube videos. Not sure if this is the right email to ask questions. As it turns out, it was. Hope this is okay. When you said the equity markets will fall as bond prices go up, do you look at the bond direction as a market indicator, or would you actually try to correlate a bond price yield to market valuation? I look at the first, the bond direction, as a market indicator. I don't correlate any bond price to yield or market valuation. I think the latter is not possible. I pretty much agree with you, as essentially the Fed buys up the bonds over time. Well, the Fed has sold bonds at one point. I don't know that they'll ever do that again, but they have. More bank and retail money has to flow in the stock market overall. Yeah, I don't necessarily agree with that opinion, because who is the Fed buying from? They're buying from large commercial banks. And where are the large commercial banks holding these bonds at? In their reserves. So all we're getting is a swap in reserves. It's not some magical new money coming into the market. So I don't agree with that at all. As the Fed owns a large proportion of bonds, I see a lot of money looking for yields and hence taking more risk in the market. Well, that is an argument for it, that, you know, as interest rates go down, people take risk in the equity market. It's a mistake, but it is, people do, you know, make up reasons to justify their risk, and certainly that is one of them. What's amazing is people say you can't make money on bonds. Go back to October 2018 and look at the rate of growth of the bond. You know, if say you bought bonds at the peak in yields there versus the equity market at this standpoint, or that same point in time. You know, go back and look at the bond market since 1982. It's beaten the equity market. Tell me when bond prices explode higher and the equity market completely blows apart, and we find ourselves not in just a liquidity crunch, but in a solvency crisis, that you can't make money in bonds. You can. A lot of investors just think of it as a yield play. Sometimes it's a duration play. So at best, we see a few weeks of bond buying, the market falling, the market takes off again. Nope, don't agree with that either, and I'll show you why. Because if that was the case, let's move that and let's go to the S&P 500. Let's zoom it out. Well, here was a point where yields crashed and the S&P dropped 52%. I mean, yeah, it eventually took off, but it took years to get back there. So it depends on how far the sell-off goes. What if it's a Great Depression and we have an 80% sell-off in equities? I mean, that could happen. You know, people say it can't. I don't know why they say it can't, but it can. So yeah, there could be a much larger sell-off than people think. How do bonds ever become attractive unless somehow there's a big bond sell-off for a while? And if there is a big bond sell-off, the stock market should rip. It should, yeah. But the question is, how long does a bond sell-off last? So hopefully that helps you understand. And please explain thanks. Well, hopefully that explanation helps you, and you're welcome to follow up if you have more questions on that. Let's see. Oh yeah, this is the one on real yields, and I need to get to that, and I intend to, but not today. So we're at the 40-minute mark, which is perfect because that's kind of where I wanted to end the extended version of these videos. We'll be back on Friday to look at the credit data, and again, this is just more validation of you can't have rising interest rates if you don't have credit growth. So again, probably one of my favorite macro data days is on Friday, but we'll be definitely watching to see the action in the bond market with 30-year QE to see if it can break through that resistance. So watch your charts and see what happens. I'll be rooting right along with you. I'm Steve Van Meter. Thanks for watching. I'll see you Friday. Bye now. The content of this video is provided as educational information only. Is not intended to provide investment or other advice. It shows not to be construed as a recommendation or solicitation by or selling security, financial product, instrument, or to participate in any particular trading strategy. This video was prepared by Steve Van Meter. Personal capacity opinions expressed in this video that I'm going to do not reflect the view of Atlas Financial Advising or Steve Van Meter Financial.